So every headline is screaming recession. For the better part of the 2 years, every expert has been calling for a crash. Geopolitical tensions or high inflation has been a nightmare, and yet the stock market just keeps climbing. It's defying gravity, hitting new highs and leaving a trail of broken predictions in its wake. If you're feeling a sense of whiplash, like you're watching a movie where the script makes no sense, you are not alone. This disconnect between what should be happening and what is happening is the single biggest mystery in finance today. It's a puzzle that has left millions of investors paralyzed, caught between the fear of missing out and the even bigger fear of being the last one holding the bag. But what if it isn't an accident? What if the market isn't broken, but it's playing by a new, almost invincible set of rules? Well, today we're going to explore the powerful unseen forces from an explosive and misunderstood boom in artificial intelligence to a quiet revolution in how we invest that was secretly propping up the entire market. This isn't about hype, it's about understanding the new engine driving the whole machine. First, let's just acknowledge how absurd this situation feels. For years, the warning signs have been flashing bright red. We've seen inverted yield curve, a classic omen of a recession. We've gone through aggressive interest rate hikes from the Federal Reserve, meant to cool things down, and the global instability seems to be the new normal, which in any other era would send markets running for the hills. Then you look at the old school yardstick of market health, and things get even weirder. Take the Shiller PE ratio, a Nobel Prize winning metric that tells you if stocks are cheap or expensive. As of late 2025, that ratio has been hovering in the high 30s. To give you some context, that's a level we haven't seen since the absolute peak of the dot-com bubble in 2000, right before the whole thing fell apart. But a time-tested measure, the market isn't just expensive, it's floating in the stratosphere. And another trusted gadget is the Buffett indicator that tells a similar story of extreme overvaluation. By all traditional logic, the market should be struggling instead of thriving. This is the great disconnect. It's a puzzle that has the average person just trying to build wealth feeling completely agitated. The old rules don't seem to apply. You're being told the house is on fire, but when you look at the Zillow estimate, the price has just gone down. It's a financial head scratcher that forces us to ask, are the old metrics broken, or is there something else going on that they just can't see? The answer is a resounding yes. The market's engine has been rebuilt and almost nobody got the new blueprints. So the first, maybe the most powerful hidden force is the artificial intelligence revolution. Now I know what you're thinking. AI, we've been hearing about AI for years, it's just another hype bubble. And you're right to be skeptical. The dot-com bust was fueled by big promises that never turned into profits. But this time is different, and the difference is all about earnings. Well, unlike the dot-com mania, the AI boom of the 2020s is generating staggering real-world profits and productivity gains. Morgan Stanley estimates that AI adoption could add over $900 billion to the S&P 500's annual earnings by 2026. This isn't a fantasy, it's a wave of cash flowing to corporate bottom lines right now. In the third quarter of 2025 alone, S&P 500 companies smashed expectations, posting double-digit earnings growth when analysts were only predicting something around 8%. But here's the twist. This AI revolution isn't lifting all boats. It's a concentrated tsunami of wealth flowing into a tiny handful of companies. You know their names, the Magnificent Seven, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. These 7 companies are now so massive that they create their own weather inside the market. They make up to close 30% of the entire S&P 500's value. Without them, the market's earning growth in recent years would have been nearly flat. They are the main winners of the AI gold rush. Nvidia is the undisputed arms dealer for the entire revolution. Microsoft and Google are weaving AI into everything, and it's fueling massive growth. This creates a huge distortion. When you see the S&P 500 index hitting a new high, you're not seeing 500 companies all doing great, you're seeing the immense strength of a few mega companies dragging the average up with them. It's like calculating the average wealth of a room with 493 people and one multi-trillionaire. The average looks fantastic, but it hides the reality for everyone else. The S&P 500 has quietly become a concentrated bet on AI. So while the headline number looks strong, the market is actually standing on a very narrow but incredibly powerful pillar of AI-driven profit. It's less a house of cards and more a pyramid balanced on its point. The second hidden force is a total change is in who is driving the market. For most of the history, the smart money was the big institutions, hedge funds, banks, and pension funds. Individual investors like you and me were called the dumb money, always showing up late and panicking at the first sign of trouble. The dynamic has completely turned on its head. Let's look at the numbers. Before 2020, retail traders made up maybe 10% of the daily market volume. By 2025, that figure surged to a record level, nearing a third of all order flow at its peak. In the first half of 2025 alone, retail investors poured a record-breaking 155 billions into stocks and ETFs. This isn't a small group, it's a tidal wave of cash. But it's not just the money, it's the mindset. A whole generation of investors who got their start on zero commission apps has been trained on the one simple idea: buy the dip. They saw the market roar back after the COVID crash in 2020. They see every pullback not as a crisis but as a buying opportunity. The old fear of a crash has been replaced by a much more powerful emotion, FOMO, the fear of missing out. This creates an incredibly strong floor under the market. In the past, a bad headline would trigger a sell-off from the big institutions. Today, that initial dip is met by a giant decentralized wall of buy orders from millions of people all over the world. It's an army of buyers empowered by mobile apps ready to jump in at first sign of weakness. This army is also younger and more active. In 2025, 2/3 of new brokerage accounts were opened by investors under 45. Gen Z and millennials now make up over 60% of the retail trading activity, and nearly half of the Gen Z investors trade weekly. This isn't your parents' passive investing, it's an active, constant source of demand. This is a permanent change, not a passing trend. It's a hidden, persistent safety net under the entire market that simply wasn't there a decade ago. We're halfway through this, and if you're starting to see the market in a new light, do me a small favor and hit that like button. It really helps to get this analysis out to more people who are trying to make sense of this new financial world. While AI and the retail army are the flashy new forces, they're standing on a foundation that's way more solid than anyone expected. The shocking resilience of corporate America and the consumers who keep it all going. Let's talk about the companies. Faced with inflation, supply chain chaos, and labor shortages, businesses, especially the great ones, have become masters of protecting the profits. The doomsday predictions of collapsing earnings just never came true. Actually, the opposite happened. Analysts are now projecting double-digit earnings for both 2025 and 2026. During the Q3 2025 earnings season, a staggering 82% of S&P 500 companies beat their forecast, one of the best quarters since 2021. And this isn't just market hype, it's backed by real cash. But a company can't thrive without customers. And for 2 years, everyone has been waiting for the American consumer to finally break. After all, they drive 2/3 of the US economy. And again, it just didn't happen. Even with everyone feeling anxious about the economy, people keep spending. JP Morgan's research team recently had to revise its forecast for 2025 consumer spending growth upwards to 2.3%. Shoppers are being smart about it, but they're still buying, especially with options like buy now, pay later, easing the sting. Consumers are bending, but they are not breaking. This provides a crucial bedrock for the economy. As long as people are spending, companies make money, and as long as companies are making money, they can post the earnings that justify their stock prices. It's a cycle that has stubbornly refused to break. If the AI giants are the market's roaring penthouse, the resilient consumer is its unshakable concrete foundation. So let's put it all together. This isn't just one thing, it's a powerful combination of forces all feeding each other. You have a historic tech boom in AI that's pumping huge profits into a few mega stocks, and they're pulling the whole market up with them. You have an army of global retail investors hardwired to buy every dip, acting as a constant safety net that stops sell-offs in their tracks. And holding it all up, you have a surprisingly tough corporate profit and a consumer base that just won't quit keeping the economic engine running. This mix creates a strange new reality where people actually expect less turbulence, not more. The market's fear mechanism, the VIX, has been signaling calm seas. This becomes a self-fulfilling prophecy. When investors think there's less risk, they are more willing to take risk, which pushes the stocks higher and make everyone feel more confident. It's a feedback loop of confidence built on these powerful new pillars. The market isn't defying gravity, it has just found a very different way to fly. This isn't about going all in or crashing out in fear. It's about being smart. It's about knowing the market is standing on a few incredibly strong but also very narrow pillars. The strategy for this new world is to focus on quality, on companies with a real cash flow instead of just chasing hype. It's about diversifying your portfolio in a way that acknowledges the huge influence of just a handful of stocks. The ground has shifted. The reason the market is still standing are hidden in plain sight, but you have to know where to look. By understanding this new entity, you can move past the confusion and start making a clear, confident decision for your financial future. So don't forget to like and subscribe, and I'll see you guys in the next video.